Alright, before we even get started with question number 1, remember that you can pause the video, you can rewind the video, or you can go ahead and stop the video and you can solve the problem before I even get started. Let's get going. Question number 1. Cindy's purchasing a home that's worth $300,000 and she has a loan amount of $240,000. What would be her loan to value? In order to solve this problem, we have to first of all determine what's the lower of the two values, the purchase price or the appraised value. Since we're not given a purchase price, we're just going to go ahead and use the value that we're given, which is $300,000. So that's going to be the appraised value or the purchase price in this case. So we're going to use the equation to be able to figure out the LTV or the loan amount, which is LTV equals loan amount divided by the purchase price. So all we're going to do now is we're going to replace the values we already have of $240,000 with the loan amount and $300,000 with the purchase price. So we're going to go ahead and do the following calculation. $240,000 divided by $300,000 equals 0.80, or at least that's what you're going to get on your calculator. And then you can convert that to 80% by simply moving the decimal twice to the right and then adding a percent sign. Now we know in this case that the solution to this problem is that Cindy's loan to value or LTV is 80%. Question number 2. Tony's purchasing a home for $500,000, but the appraised value is $495,000. If the loan amount is $400,000, what would be his LTV? Now it's very important that you listen to what they're actually asking for. So if we're being asked for the LTV, that's all that we're going to solve. Now we already know that we need to use the lower of the purchase price and the appraised value. So in this case, he's purchasing a home for $500,000, but the appraised value came back lower, $5,000 lower, which is exactly for $495,000. So to be able to calculate the LTV, we're going to use the same equation, loan amount divided by the appraised value. Now, we're going to replace the values by simply replacing the loan amount with $400,000 and the appraised value with $495,000. And we're going to see that the LTV equals 0.8080. And we're going to convert that to a percentage, so it's actually going to be 80%. So now that we did the calculation, we know that Tony's LTV is 80%. And that would be the solution for this problem. Question number 3. If a borrower comes into your office and says they want to refinance their current mortgage, and they owe $100,000, and they think the value of the home is $300,000, how would you calculate the LTV or loan to value? Now, even though the borrower came into your office and they're giving you a value, you still need to verify or at least have a closer idea of what the property is really worth. In order to do that, you can use a website like Zillow.com or Realtor.com and simply enter their address on the search bar. And when you do, you're going to see that it's going to give you the estimated value of the home. Now that estimated value isn't 100% accurate, but it gives you a much better idea of what the home is actually worth. Sometimes it's wrong, sometimes it's spot on, you never know. So we're going to use that value. Now we're going to go ahead and calculate the LTV by replacing the loan amount and the appraised value with the numbers that were given. So the LTV is going to equal $100,000, which is the loan amount, divided by $300,000, which is the estimated appraised value. And we're going to get an LTV of 0.3333, which we know is going to be 33.33% once we convert it to a percentage sign. Now, you can go ahead and estimate a value and simply say it's approximately around 33%. And in this case, that's how you would solve a problem when a borrower is refinancing. Question number 4. If you decide to buy a condo that's worth $180,000, but appraises for $200,000, and you only put 5% down, what would be your LTV or your loan to value? Now, if you're buying a condo that you have a purchase price for $180,000, but the appraised value is higher, would you be able to finance off the $200,000? No. It's always the lower of the purchase price and the appraised value. So in this case, the lower of the purchase price and the appraised value is $180,000. Since they put a 5% down payment, we're going to go ahead and figure out what the LTV is. Now, if the total value of the home or the total purchase price is 100%, we're simply going to subtract 5% from that 100%, and we can figure out that 100 minus 5 is 95%, and that's going to be the LTV or the loan to value. Question number 5. Sammy's purchasing a home for $424,000, but the appraised value is $405,000. So now we know that the appraised value came back lower. If the loan amount is $390,825, what would be his LTV or his loan to value? Now in this case, Sammy can do a number of things. He can go ahead and simply pay for the difference between the purchase price and the appraised value. So you would subtract $424,000 minus $405, and whatever that difference is, Sammy would have to pay in addition to whatever he puts as a down payment. Or he could renegotiate with the sellers and get them to bring the purchase price down to whatever the appraised value came back at, which is more reasonable and which is a better way of doing things. But in this case, let's go ahead and calculate the LTV. So we're going to use the loan to value equation. So we're going to divide the loan amount by the lower of the purchase price and the appraised value. So we know that the loan amount is $390,825, and we're going to divide that by $405,000 since that's the appraised value. And we're going to get a loan to value of 0.965, which is also 96.5% financing. Now, most loans that have 96.5% financing are usually FHA loans. So it doesn't exactly need to be an FHA loan. It could still be a conventional loan, but we're going to assume that it's probably going to be an FHA loan. And that's how you would solve this problem. We calculated the LTV for Sam. Question number 6. Carla's buying a multifamily home for $330,000, which only appraises for $297,000. What would be the LTV if the loan amount is $250,000? Now, as we can see again, the appraised value came back lower. So we need to use the lower of the purchase price and the appraised value. So let's go ahead and use our equation. LTV equals loan amount divided by the lower of the purchase price and the appraised value, which in this case is going to be $250,000 divided by $297,000, which is going to give us an LTV of 0.84, which when we convert it to a percentage is going to be 84%. So Carla is financing 84% of the appraised value. Now remember, Carla can go back and renegotiate the purchase price and make it the appraised value, or at least get as close as possible, which is always a good idea, especially in these circumstances. Question number 7. If a borrower tells you they want to finance 90% of a property they're purchasing for $279,000, what would be the loan amount? Now that's why it was important to know the variations of the same equation for the LTV. So we're just going to flip the numbers over and turn them so that we can calculate the loan amount. Now, if we know that the loan to value is 90%, then we can go ahead and do the following calculation. So LTV is going to be 90%. So 90% equals the loan amount divided by $279,000, which is the purchase price. So in this case, we're going to move the $279,000 over to the 90%, and we're going to calculate the loan amount by doing that. So instead of having 90%, we're going to convert it back to a decimal, so it's going to be 0.90 times 279,000, which equals 251,100, and that would be the loan amount. Now, there's more ways of calculating this, or moving the numbers around so that you get the right equation, but this is a simplified way. That's why I explain it to you that way. And you can double check the work and you can review the question once more in case you were a little bit confused. Now remember, all we did is we moved the numbers over or the factors around so that we could solve for the loan amount. That's why it's a good idea to go back and check the variations of the same equation so that you can try to get an idea of how to calculate that and in which order you need to have all the factors to be able to calculate or figure out each one. Question number 8. So Fiona is refinancing her home, which is worth $450,000. So that was the appraised value. And then she thinks that the property is worth $600,000. What would be the loan to value if she currently owes $278,000? Now, if her mortgage is $278,000, even if she thinks the property is worth $600,000, sometimes borrowers have to be realistic, and you have to tell them that the bank or the lender won't finance more than what the appraisal comes back at. So you can either show them on Zillow.com or Realtor.com what the value came back at, and then you can give them an idea if you don't have an appraisal yet. But if the appraisal came back, then you can show them the actual appraisal, and then you can tell them, that's what it came back at. If the borrower doesn't complain anymore, or if they're not worried anymore about that and they accept the fact that the appraisal is that, then that's perfectly fine. If not, you can always suggest to have another appraisal done, but they would have to pay for that appraisal. And then once they order that new appraisal, then if the value comes back lower, then they know that they should have simply stayed with the other appraisal. And if the appraisal comes back higher, then that's great for them. It was a small investment they had to make, but then the value was a little bit higher. Now let's focus back on calculating the LTV. So the LTV is going to be $278,000 divided by $450,000. So in this case, the LTV is going to equal 0.617 or 61.7%. In this case, you have to notice that since the LTV is under 80%, this borrower is not going to have mortgage insurance. So if they did have mortgage insurance before, this is going to definitely benefit them because now they're going to eliminate mortgage insurance. So this is very good. Also, when they don't have mortgage insurance, their DTI is going to be lower because that's an additional cost that won't need to be factored into the DTI or the debt to income ratio. Question number 9. So Heather's purchasing a condo for $80,000 and she only has enough for a 5% down payment. If the appraised value comes back at $85,000, what would be the loan amount? So in this case, this is going to be a two-part solution. First, we have to figure out what the LTV is, and then we're going to calculate the loan amount. So since we know the lower of the two, the appraised value and the purchase price is $80,000, so that's the value we're going to use to be able to calculate the LTV. So if she's giving 5% as a down payment, we need to subtract 100% of the purchase price minus 5%, which will give us 95% as the LTV. Now we know the LTV. Now we need to solve for the loan amount. To solve for the loan amount, we need to multiply $80,000, which is the lower of the purchase price and the appraised value, times 95%, which is the LTV. And we're going to get $76,000 as the loan amount. Now, we know that $76,000 is the loan amount, and if we subtract that from the $80,000, which was the purchase price, we now know that her down payment was $4,000, and that was an easy way to solve for the down payment. So if she tells you, how much do I have to give you in terms of a down payment, you can tell her she has to come in with $4,000, which would be the equivalent to 5% of $80,000. Question number 10. So if a realtor calls you and they need to determine what the loan amount is going to be for their borrower who's purchasing a single family residence for $700,000 and is coming in with a 20% down payment, how would you calculate the loan amount? So first of all, we know that 20% down means that they're going to be only financing 100 minus 20, 80%. So they're going to be financing 80%, and that's going to be the LTV, which also means they're not going to have mortgage insurance. So that's going to lower the DTI as well, the debt to income ratio, which we will see in the following exercises. Now, to be able to calculate the loan amount, we need to use the variation of the same equation for the LTV or loan to value, which is going to be loan amount equals purchase price times 80%, which is the LTV. So in this case, we're going to go ahead and replace the values, and we're going to have 700,000 times 0.80, which equals $560,000. So now you can go ahead and call the realtor and you can tell them that the loan amount is $560,000. And then you can go ahead and quote them an interest rate now that you know what the loan amount is.